Hello, everyone. Welcome to the final bar. Today, we're going to talk about breadth and sentiment characteristics. We've talked about euphoric sentiment for a while, really hit a fever pitch a couple weeks ago, started to taper off a little bit. So less euphoric, but still overall similar patterns to what we've seen at other market tops. The breadth conditions are what are really compelling to me, especially on the short term. You're seeing some divergences between price action and breadth, which suggests to me to be wary of further upside. We're going to look at all those charts and also a segment called The Mindful Investor. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of stock charts, using data visualization, focusing on the message of the markets through the tools of price, breadth, and sentiment. And today, really, we're going to focus on all three of those. We've had this conditions when you're looking at breadth, which has been overwhelmingly positive, the trend, which has been overwhelmingly positive, the sentiment, which has been euphoric. It's gotten to extreme bullish levels. Those are similar patterns to what you would see before a major market top. But what you have not seen are all the signals that immediately precede the market top until now. I think you're starting to see a tapering of extreme sentiment. You're starting to see breadth characteristics in some forms that are starting to roll over, not all of them. And we'll do a deep dive on breadth readings today, focus on some of the different signals. We'll see which ones are remaining more constructive and which ones are flashing more negative, but certainly seeing the weight of the evidence suggesting a bit of a rocky road here for the next 4 to 6 weeks would be my guess. But it all has to happen on the charts first. Until proven otherwise, the trend remains in place. Now, we have some great guests coming along the way. Yesterday, we had Julie Stekempeter. It was a great discussion about sector rotation. I had a lot of fun thinking about how to visualize that and some of the key sectors to focus on. And Bruce Powers on Tuesday did a really fine job as well. Next week, we have Tony Zhang, who's the chief strategist at Options Play. So an options take on Tuesday with some ideas for us right about now. On Wednesday, February 3rd, we have Louis Llanes, founder of WealthNet Investments. Louis is one of my favorite quantitative strategists. He has a great way of just breaking down portfolio analysis, risk, ideas using the quantitative methodology inspired by technical analysis. And then on Thursday, Leslie Juflas. Leslie's a fellow CMT. She's the founder of Trading Live Online and is a frequent guest host of Your Daily 5 on StockCharts TV. Does a really nice job. And I'll be interested to hear her latest ideas on Thursday. Let's get to our market recap. So as we've talked about, today was really in rally mode, and it certainly looked as if we would push to new closing highs potentially. It was just this acceleration out of the open. And yesterday, if you remember, quite the down day, an unusually strong down day, down over 2%. And then today sort of reverted right back to the upside. What was interesting is after lunch around 2 p.m. Eastern, a lot of that, about 2/3 of that was given right back. So, if you're thinking of the message of the markets in the short term, the market coming off in the last hour or two suggests, and I'm generalizing here, suggests more institutions lightening up. It talks about more of a de-risking. It talks not about, the market sort of rallies into the close when big institutions are taking on additional risk. If prices going down like this usually means that they're getting defensive, taking bets off. And that may be some of what we're seeing. Again, it's, one day tells you a little bit. I think a succession or a progression of days is what really fills in the blanks for you. Having said that, the S&P finished about 1% higher, still finished just below 3,800 to close around 3,787. The mid cap and small cap index very noticeably were down pretty big. So while the mega cap index doing just fine, the two others struggling fairly mightily. So, think about that when you're looking at the relative movements of them, mega cap working, small caps not. It's kind of an interesting comparison. The NASDAQ 100 up a little less than the market overall, but okay. Looking at some non-equity asset classes, bonds essentially weakened, sort of the inverse of the stock performance. You had a downtrend through the course of the day, but then a rally starting around 1:30 Eastern. The dollar as well weakening off a little bit. Commodities, we had gold and silver. Gold essentially flat. Silver, the big winner in the commodity space, really gapping higher and then accelerating into the close, up almost 6% on the SLV. The commodities as a whole were down with energy prices going lower. Cryptocurrencies all fairly strong, and Bitcoin really has chipped away, continuing to push higher back above that 32,000 level that we've talked about a number of times, but really accelerating back into the 30 handle, kind of continuing a little bit further to the upside. So plenty of volatility, obviously, in cryptos. And I think that long-term in cryptos is about a week and a half, but that overall, I think, cyclical move of weakness in cryptos could certainly still be in play, with plenty of opportunity for further downside. But it has to get through that first support level. And that's where we're going to start here, looking at the chart of Bitcoin. Again, Bitcoin is not the main thing I want to ever focus on, but I think that we are past the time. The time when you can ignore cryptocurrencies is behind us. I think as an individual investor, as a financial advisor, even as an institution, you have to just think about the implication of the risk perspective of cryptocurrencies and how people are using them relative to other assets that could certainly be things that you are holding. If you look at what Bitcoin has done in the last 24 hours, it's pulled back to the 38.2% retracement of the September to January run. That is a support level we've hit a number of times over the last 4 weeks or so. But more importantly, it's also bounced right off the 50-day moving average. So we have what's called the confluence of support, multiple indicators, multiple techniques, all sort of agreeing that the same general area is really important. So essentially the 29,000 to 30,000 level is a really key area of support. As long as that holds, this constructive pattern continues, and this can be seen as a bit of a pullback before the resumption of an uptrend. If and when that breaks, I think you have to start looking further down to 26,000, down to 22,000. I think if we break 29, I would expect 22 to be a reasonable downside objective. Still keeps this overall long-term uptrend in play, but it's a bit of a deeper correction to shake out some more speculators and sort of reset. And you get down to there, I think you'll have a lot of people excited to get in at a much lower level and ride it to new highs. But first things first, see how it does around some of those key support and resistance levels. Let's look at a daily chart of the S&P, and then I want to show very quickly an intraday chart of the S&P. If you look at the daily, you'll notice that, oops, wrong chart. You'll notice here that, here we are, that the trend has been positive. The trend has continued to push higher, higher highs, higher lows. And overall, that has generally been in place. What's interesting recently is this trend line using the previous swing lows, right? So if you take a trend line from the low here and you connect it, whoops, I don't have a trend line going, sorry. Here we go. If you take the trend line here, this is the line we've been talking about, which is basically taking the low from the end of October, connecting it to the low beginning of January, retested it. We now broke it, and this was yesterday's trade certainly signaled a broad downtrend. A break of that trend line is the first warning signal that things are getting overheated. The question then is, do we break this previous swing low? And as we close right about that level we talked about yesterday is, all right, we either get follow through, we get confirmation of further downside, or we bounce off support and we have to wait to see if that interim support is broken. We got our message today with a bounce back to the upside. Almost got back up to that trend line right there, closed about midway through the range, a little bit lower than halfway back up that today's trading range, but overall still remaining above 37.50, which is that swing low from about a week and a half ago. As long as that holds, I would argue that the short-term trend, the tactical trend, still remains positive. Remember, an uptrend is higher highs and higher lows. As long as we keep making or sustain the higher lows, that uptrend is in place by definition. So we're still, I think, looking at that level. We'll see going into Friday's session if we finish the week in a position of strength and keep holding that 37.50 support level, or if we start to go lower and we need to think about further downside potential. You know, I kind of laughed setting up this chart. Anytime I see a run in the first half of the day, I'm always tempted to bring up a Fibonacci retracements, because more often than not, you retrace about 2/3 of the way back down. This is the 61.8% retracement level, taking the opening sort of 5 minutes of the SPY, taking the high around 1:35, 1:40 p.m. Eastern. You can see from then we made it back just actually below. We bounced off the 61.8% retracement level. I thought that might be the low for the afternoon. We actually continued further on and kept chipping away further and further. So if you look, this whole last couple hours was really a series of distributive patterns, right? Continuing moves further and further to the downside. Let's look at the Mindful Investor Live chart list very quickly. We're going to talk a little bit more deeply about breadth, so I don't want to get too deep into that just yet, but I did want to talk about sentiment. There's two charts when we talk about sentiment, two things we'll go for. Number one is the AAII survey. This is the American Association of Individual Investors. It's a survey that's been going on for years and years. And what's helpful, even though it's a relatively small sample size of a subset of the investing community, it certainly has been a consistent input for or consistent data source for many years. What's interesting is what I'm seeing right now is if you look at the big euphoric level of sentiment, this came the first week or two in November. This is when the market was pushing to a new high here, a new all-time high for the S&P 500. You can see that the AAII survey got to over 50% bullish on the bullish, 50% bullish respondents, which is unusually high. Since then, it's been sort of a slow and steady tapering off, especially in the last month. You can see the difference between these two has tapered off as well. For me, what concerns me is it looks a lot like December to January of 2018, where you had a big spike in euphoric sentiment. You came off over the next month or so. You had a tightening of the spread between the two, and that ended up being the 2018 peak for the first 6 months. The next 2 months were pretty painful. Combine that with the name exposure index, which is the percent of money managers, how long they are, 0%, 100%, 200%. It was about 116% last week. 112%, 113%, if I remember right. That's the second highest reading in history, second only to December of 2017. It's about a month before the peak in 2018. It's come off quite a bit. So you've gone from 112% down to about 83, 84%, which is a big swing, which starts to tell me money managers, active money managers, starting to take some of their bets off. That could be an early warning of potential for further downside. Or certainly they're seeing the reason to take some of the risk off and de-risk a bit in their portfolios. That's our market recap for today. Again, there's so many different things we could go through. I wanted to hit on some of the sentiment reads and some of the big picture charts. We're going to take a break. We'll be back with the Mindful Investor. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. So good to have you join us every weekday after the close for my show as we review the action of the markets through the charts, through technical analysis. Again, I feel like 30 minutes goes by so quickly. We try to touch on as much as we can, often have a guest on to get their insights as well. One of my favorite parts of this show is the interactive nature of it. And we'll do another mailbag segment at the end of this week on Friday's show. We would love to answer one of your questions on the air. Nothing is out of bounds. Ask us about the markets, about short squeezes, if that's top of mind for you, about supply and demand, investor psychology, whatever it is. We're happy to point you in the right direction. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. Hope to answer one of your questions on the air on Friday's show. Our next segment is called the Mindful Investor. My blog on StockCharts.com has that name, the Mindful Investor. And when I first talked with Chip Anderson and Grayson Rose about what sort of voice I would want to have in a blog and what we want to do, I shared with them my experiences of applying mindfulness techniques and mindfulness lessons to investing. And, very quickly, if you haven't heard this before, years ago during a particularly stressful time, personally, professionally, I had found many unhealthy ways to try to deal with that stress and was introduced through my employer with mindfulness techniques, with mindfulness meditation and some other things. I went through a 6-week course with an instructor and a group of my coworkers, and it was transformative for me. I came out of there feeling more relaxed, feeling more aware, calmer, having a much greater appreciation for where I was and where I'd been and where I was headed, and just embracing the reality of how things were, and basically focusing on what was around me, having an increased sensation or increased awareness. And I found, as I worked with financial advisors on my own firm over a number of years, I found that those lessons, there was a lot of the same challenges I had been facing personally, or the same challenges that active investors face. And the biggest reason why that is, getting to the slide that you see in front of you, is just fear. I would say overall, I was taught, 20 some years ago, when I was learning about the financial markets, I was taught that the markets were driven by fear and greed, and that the markets went up because of excessive greed and they went down because of excessive fear. And I'm oversimplifying, but you get it. And for me, having studied psychology as an undergraduate, it just clicked. I mean, it made sense, obviously, that the markets would be driven by emotions, because they're driven by human beings making decisions. And that was an easy sell. But I think over time, what's happened is I've learned that it's not just fear and greed. I would argue that it's now all about fear. I think on the upside, it's the FOMO, it's the fear of missing out, that motivates our buy decisions more often than not. I think on the downside, it's the fear of losing everything. It's the fear of something going to zero, another big crash, a big correction like we saw in February, March 2020. And so fear is what you really need to get on top of. So I think part of being a mindful investor is minimizing the impact of your own fear, your own anxiety on your investment decisions, and also taking advantage of the fact that other investors are not so mindful about how they approach it. Take advantage of the fact that that your peers in the industry trying to answer some of the same questions you are struggling. So what I try to do with my clients is advance them from what I would consider the mindless investor to classifying themselves as more of the mindful investor. And I'll share with you what we generally work on. And hopefully, I hope over this 2 minutes, you can get some ideas of how you can maybe improve your own decision-making process. For me, the mindless investor, their main problem is an unhealthy relationship with three timeframes: their past, their present, and their future as an investor. And I would point out, obviously, we're talking about this from an investment perspective. I think you'll find that your investment decisions are just one set of decisions you do every day. And so this is probably applicable to other parts of your life as well. But as an investor, we love to ignore the past. When we have a tough stretch, when you miss out on something, when you have a really bad trade, we love to move on from that, to protect ourselves, protect our ego, protect our mental state. We sort of move on from that and focus more on what's coming next. We fear the future. We have no idea what's going to happen tomorrow. And anyone that goes on financial media and tells you they know what's going to happen is lying to you or to themselves. None of us know. We can make educated guesses and we can, understand probabilities, but in the end, it's uncertain. And for a lot of investors, that means they're fearful of that. And because we don't have a good relationship with our past and our future, we worry about the present. The unknown of the flickering ticks of right now cause us anxiety. What I would hope you can do is get more to what I would call the mindful investor. And you can see that you now have a much healthier relationship with all three, and you're connected to all three of them at the same time. Instead of ignoring your past, you learn from the past. So you have a regular routine to review your decisions and embrace your good decisions, and also embrace some of your less good decisions and learn from some of those mistakes that you've made. If that's an area you want to focus on, I would encourage you to go to some of our year-end programming. We got a whole series of interviews with Keith Fitzgerald, with Gaddis Rose. I did one as well, focusing on how you wrap up your year from a performance standpoint. How do you look back and evaluate how you did as a trader, as an investor? And I'd encourage you to check out on our YouTube channel some of those videos. You live for the present, right? You have the ability to focus on what's going on around you because you have a good market awareness. You have a regular routine for analyzing the markets. And I hope on this show, what we do on Friday, what we do on Monday, which is the Mindful Investor Live chart list. On Monday, it's looking at the market, top down, sectors, and bottom up. That regular weekly routine is what's going to help you have a better awareness of what's going on around you. And finally, in terms of planning for the future, you have to have a good way of looking at the environment and setting your bets and having a trading plan that you're going to be able to follow consistently. And if there's one thing I would tell you, it's having a consistent process. An imperfect but consistent process is way better than a perfect but inconsistent process. And think about that and how you can improve it. If that's something you want help with, I would go to my YouTube channel called Market Misbehavior. I have a lot of videos that I post every week trying to help you think about how to improve your routines and your decision-making process. That's the mindful investor. Here's hoping we all get from the more mindless practices to the more mindful practices. Having said that, let's continue our process of understanding the current market environment through breadth analytics. We talked about sentiment a little earlier, the euphoric readings that had come off a little bit. Now let's focus on breadth. And I have a breadth chart list that I use for this. If this is something you'd be interested in, On your dashboard, there's a chart pack that I've created called It's like DK's or David Keller's morning coffee routine. It's free for members. Go ahead and install it, and you'll have all of these charts as well as a bunch of other chart lists. But we're particularly looking at the breadth chart list within that free chart pack right now. So let's look at some of the different measures of breadth. Remember, breadth always relates to participation. When we talk about breadth, we're talking about participation. The market's doing one thing. How many stocks or what percent of stocks or what type of stocks are participating in that same move? And in general, when those agree, when the market's doing well and most stocks are participating, that's a good thing. When the market's doing well and a lot of stocks are starting to not participate in that uptrend, that can be a bit of an early warning that things are starting to roll off a bit. I will warn you as we look at some of these breadth charts, a lot of the breadth data for us gets processed after the close. So these may not be updated for today's trading, for Thursday's trading just yet. I'd encourage you to look at the charts a little later this evening after 5, 6 p.m. Eastern, and you should be able to see the updated data. Here we're looking at one of my favorite breadth charts, which is the S&P 500 at the top, and then it's the cumulative advanced decline lines for each of these different universes. We have the New York Stock Exchange common stocks only there. We have the S&P 500, the S&P Mid Cap Index, and the S&P Small Cap Index. In general, higher highs, higher lows are an uptrend. That's what we talk about for price. We're also talking about that in terms of the breadth reading. So as long as these indicators continue to make higher highs and higher lows, then the trend is positive. What's interesting right now, and this is as of Thursday's close, you can see for the NYSE and for the S&P large cap, both of those had actually pulled right back to their 50-day moving average. Now, these advanced decline lines, for the most part, have all been above their 50-day moving average for much of the last 3 or 4 months. The last time they were all negative was here in September, which was that choppy market environment after the September peak. Then we had another choppy period in October before resuming the uptrend in November. And you can see that all of the cumulative advanced decline lines finally made new highs. That was one of the signs that told me to assume that the trend is now positive until proven otherwise. So this is one chart that I don't think is turning negative yet. I don't even know if I would call it neutral yet. I would say these holding their 50-day would be one thing I would be looking for. The swing lows from last December would probably be the most important ones. And as long as we can remain above them during a pullback, I would argue that overall the breadth remains fairly constructive using this particular chart. If we break down through those December lows, which is sort of the last swing low on each of these advanced decline lines, I would be concerned about the probability or the increased probability for more downside. Now, we can also look at advanced decliners on individual days. Here we're looking at just the daily advanced decline readings. And so upstairs here, we're basically taking a cumulative measure of the green and red bars that you see here at the bottom. This is more of a daily read. This is where we look at how many stocks on a given day are up or down, and 90% up days, 90% down days. That's the blue horizontal line that you see in each of these two panels. That would indicate a severe, one-sidedness to the market, right? When 9 out of 10 NYSE listed stocks are up or down on a given day. It happens very rarely. The last time we've had either signal was the end of October, which is really the end of this pullback. You can see at the end of these pullbacks, you had these 90% down days, which are really sort of the end of that move, a bit of a capitulation to the pullback. Yesterday, with all the distribution, it was still only about an 82% down day, just in terms of a price basis. Now, that's the highest it's been since October, but it's still not climactically bad. That could be just the beginning of something further. And I think if you look back here, like in September, those first couple down days, you saw an increase in the stocks that were down about 4 out of 5, and that's about what we saw here. So I would need to see a cluster, some more of those to indicate further internal weakness. Today, for example, when we looked at this a little earlier, I'll refresh it one more time and see if we've had a change. Nope, it's about 68% of the New York Stock Exchange back higher today. So, overall, we'll have to see how that evolves and see if you continue to get some negative readings. We're going to skip a couple here. This is a chart we talked about yesterday, I think, or the day before, as part of our 3 and 3. This is the percent of stocks above their 50-day moving average. Here's the price of the S&P. This is the S&P's 50-day moving average, around 37.14. This is the percent of S&P members above their 200-day moving average, still very high, around 88%. This is the percent of stocks above their 50-day moving average. As of yesterday's close, it was below 50% for the first time since the end of October. So the last time we got to that sort of level was back here during this most recent real corrective pattern, this deeper correction in September and October. So this may be the beginning of a pattern that sort of indicates that sort of deeper correction. And remember, markets can correct in 2 ways: in price, meaning a pullback in absolute levels, or in time, which would be it takes time at a, it's sort of hits an equilibrium and waits a while before resuming an uptrend, or it can be both. It can be price and time. So remember that those are a couple ways that the market could correct from here, depending on what we see. So this is not unusual. At the beginning of a topping pattern, you would see this sort of pattern where the percent above their 50-day comes off, which indicates a number of stocks, sort of like CSX or others, that have broken down through the 50-day, but not quite to their 200-day, because overall the long-term trend remains positive. That's sort of what you would see. This percent above their 200-day, if and when that starts to come down, that would tell you definitely a change of character, because that has been above around 80-90% since November, since mid-November. That gets back below 80%. That would be something that would tell me that the character has changed enough to be worried a little bit. So the percent above their 50-day, maybe the first thing we've looked at so far today that suggests to be a little more cautious. We only have another minute here, if that. So I'm just going to hit on three other charts very quickly. One is the number of new highs. We have seen a continued number of new highs. About 8 to 10% of the S&P made a new high yesterday, which isn't bad. But what's worth noting is that's down from about 22% at its peak. So you're getting less and less stocks in the S&P making new highs. So as the S&P has pushed to one more new high, you can see that many less S&P stocks actually made a new high along with the index. So that tells you that many stocks, just like the percent above their 50-day, a number of stocks are actually starting to roll over a little bit. We're also seeing that from the bullish percent index. So we're almost down to 50% again, which is sort of our general indication of bullish or bearish sentiment. This is based, or Brett, this is based on the bullish percent, which is how many charts in the S&P 500 are in a point and figure buy signal or a point and figure sell signal. It broke down below 70, which is tends to be called like a bear alert, which says it's been strong and it's starting to weaken a little bit. For me, breaking below 50% would put it back to the end of some of these corrective periods. That's what all these major pullbacks through the second half of 2020 all had, that similar pattern where we got just below 50%. So if and when the market would continue lower, that would be one of the first charts I would pay attention to. Finally, it's worth noting the McClellan oscillator broke down below zero and is pretty significantly below that, which is certainly more characteristic of a downtrend than an uptrend. That being above zero speaks to stronger breadth, below zero speaks to negative breadth. So, what we've done here, if you look at these, and I'm sorry we don't have time to go through more of them. If you have questions on particular ones, just shoot me an email and we'll go through them in a little more detail later in the week. But it's worth noting that breadth has gone from 100% positive to, I would say, maybe 50% positive and 50% cautious, which is sort of what the beginning of a deeper downtrend would look like. It could just be the end of it, and we'll see things turn back more positive, and that's why these charts are really key to watch. We need to wrap this show, though. We're out of time. Go to the 3 and 3 charts, 3 minutes. Here it is, chart number one. We just talked about breadth and all the different ways we can measure it. I'm interested and I'm curious about the fact that less and less S&P members are making new 52-week highs. If the market's healthy and the market's pushing to new all-time highs, you want an increasing number or a healthy number of S&P members doing that same thing, because that tells you it's a broad advance. We're seeing less and less S&P members make a new high, especially as the S&P itself made a new high last week, and that's concerning. Chart number two is Tesla. We have a bearish divergence right now in Tesla. Tesla, obviously with earnings this week, a lot in the news, and a lot of looking at this company now, obviously with a bit of an earnings miss this week, but the stock recovering pretty well. Didn't sell off too much today, but you do have this pattern of higher highs in price, lower peaks in RSI, which tends to be a topping pattern. The problem with that thesis, I will save you the argument of saying, yeah, but what about in December? And you're absolutely right. You had the same pattern in December, higher highs in price, lower peaks in the RSI. That was negated when the index, or when Tesla made a new high and the RSI broke out of that trend line. So overall, this is certainly, bearish divergences are not 100% accurate. And I would say it's sort of like recession, an economist calling recessions. It calls 10 out of the last 3 pullbacks. However, most pullbacks have that pattern, which is why I pay close attention to that signal. Finally, airlines, certainly we've talked a lot about in the industry, and I think in the news, American Airlines has come up as being one of those shorted names, those value names that have been seen a lot of activity. I think it's worth noting with a chart like JetBlue, if and when it breaks resistance, I think you can get interested in a break above 16 on a chart like JetBlue could indicate the potential or stronger potential for further upside. Until then, though, this is a chart that has met resistance and has met its match, and it's not been able to do that. Stocks that can't get above their June highs, I can't believe that there's very much upside or attractive risk reward until it can do that. Folks, that is our show for today. Thanks so much for joining us. Get your questions in. Shoot us an email. We'd love to answer one of your questions in our show on Friday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.